Okay, we are live. Hello. Welcome back, investors, to Ticker Time News. I am Adam, and this is going to be a choppy week, so be prepared for it. And as we start out, this is the S&P 500 on the chart here. And if you want to follow along at home, you can. There is a link in the description of this video to TradingView. Click on the link, sign up for a free account, doesn't cost a penny, and you can follow along with all the charting that we do. It's all on TradingView. All right, a stock market that started to move higher today. You can see it on the left side of this screen. A gap up early in this morning, thinking, oh, is this going to be an interesting and fun day in the market? Well, it was a broad-based move higher all across the market to start the day, but it ended the day mixed in a disappointing fashion. You can see the sell-off that happened early morning, and then it just kind of bounced around for the rest of the day. Now, the main disappointment was the recognition that the early rally could not be sustained. That's the big disappointment, especially coming off another week of losses. If we look at the S&P 500 on a weekly view, you can see, well, I know it's a bit hard to see. There's all kinds of boxes and lines and everything here. Let me move that. You can see the candle all the way to the right. That is this week's candle. That is today. If we go to the next candle to the left, that's last week's candle. So we had those 7 hard red weeks in a row. Then we had that beautiful green week, right? But last week we got another red. We could not sustain this effort. So if you are looking to go long in this market, now is not the time to do it. If you're looking to go short in the market, well, your risk reward is probably a bit better right now to short the market instead of trying to go long the market. Now, there were some favorable, and I'll switch this back to the daily view and put all my lines and craziness on here. I'll take volume off after I point out one thing here on the chart. Let me get it squished back up here. On the bottom, the red and green on the bottom here with this blue line going across the top. It's all the way towards the bottom here. Those are your volume candles, right? They're pointing straight up and down. Volume right now, as we continue to move, we can go all the way back to May the 10th. So nearly a month ago, we can start our line there and we can drag it to today. And you can see volume has been declining for the past month, nearly a month. So volume declining. Price action was rising, stalled because it reached resistance. And now we are going to chop around. We're going to ping pong. We're going to just move sideways. That's the move we're setting up for right now. That's what it looks like. Volatility will be the leader of what's going on in the market. So just keep those things in mind. Volume is decelerating. It's going down. That means less and less, or fewer and fewer people are being engaged in this market. Now, when you have a low volume supply, price action can actually move at a quicker pace. For example, if you have 200 people, right? You have 100 buy, 100 sell. Price isn't going to move, right? Because you're equal. Now let's say there's 500 people. We have 200 people buy and 300 people sell. The market's going to go down. That's right. Let's say we have 100 people. And let's say all 100 people buy and 0 sell. I don't think we'll ever see a day like that in the market, but just a fun little exercise here. The market would go up, and it would go up at a big pace because that would be 100% of market participants buying and 0% market participants selling. So the market can react much quicker if we're looking at it that way, right? Okay, so volume is going down. It's going down. We're going to get, I think, some rapid movements back and forth, and that's going to go into the choppiness of this market. Plus, we're sitting right up against resistance, so the risk reward right now doesn't look good for going long or going up or higher. The greater reward is to go down in this moment in time, but that can change day by day if you're doing this day by day. Okay, let's move on with this. There were some favorable price action in the market today. Mega caps, they had some optimism over reports that China is loosening. I know we hear about this all the time. China is either loosening or China is tightening COVID restrictions. We hear it all the time. I'm almost getting sick of this headline. I really don't think it's playing that big of a role in the market, but it does play a role in certain sectors or stocks. If companies that have a lot of manufacturing done in China, they can be affected. And if there are Chinese companies who are trading on the stock market, Alibaba, Didi, for example, they are affected by this news. So I'm getting bored with it on a daily basis, whether they're tightening or loosening their restrictions. I just want it all to be in the rearview mirror and us to get past the COVID. And yeah, come along, China. Let's move on from this. Also, there is some relief. Joe Biden did signal today that there will be some relief from tariffs and regulatory matters fueled. Well, they did fuel the initial buying. So for solar stocks, for example, right? If there's less tariff, if there's less regulatory pressure on solar manufacturing, solar companies in general, they're going to do a lot better, a whole lot better. And that was a big boost for the solar sector of the market today. So that was good. I like seeing that. Now, before we dive any deeper into this, I just want to share this news with you. I got an email from Webull. And if you have not signed up for a Webull account just yet, do so, because Webull is, well, let's close out that box. They're trying to push something else on me. Webull is giving away 6 free stocks. And as a matter of fact, let me put this up here. Boom. 6 free stocks valued up to $12,600. All you have to do is open an account, deposit any amount, and this is seriously, this is one of the best return on investment or ROIs that you could possibly get. It's nearly free money. So open an account, deposit any amount, even a single penny, and get your 6 free stocks valued at up to $12,600. Just click the link. It's the second link in the description of this video, or you can go to tickertimenews.com/Webull. All right. For new investors, this is a great start to your investor journey. So take up this offer. All right, let's get back into the market and what's happening here. So let me unclick that button and let's click that button. Don't want to go to Twitter just yet. Okay. Solar stocks, Chinese ADRs, they saw some of the biggest moves today. Solar stocks were helped, like I just said, by a Wall Street Journal report that said the Biden administration is going to institute, or is not, I said that wrong, is not going to institute any new tariffs on solar imports for 2 years. That's excellent news for solar. Then we have Chinese ADRs. They got a boost from a separate report suggesting Chinese regulators are ending their probe of Didi. And just look at what happened to Didi today. DIDI is the ticker for Didi. Look at this amazing gain. 24.3% today, based off of news that they are not under any more scrutiny from the Chinese government, and they just shot off. I mean, and this is a company that has just been down, down, down. Except for, when they were listed on the stock market, they had a pop, but man, they had just been hit hard constantly. I mean, there's like no rallies in here whatsoever. So that's Didi, $2.30 a share. Nice pop today. Really good pop of 9 cents in the after hours, 45 cents during a regular session. Okay, moving off of that, the biggest influences, I would say, on the major indices, though, were the biggest stocks. My favorite way to measure it, the Vanguard Mega Cap Growth ETF, ticker symbol MGK, because it holds all these big cap names. Look at this. And what I want to show you is the 5-minute. Okay? The 5 minutes, I know it's choppy. It's an ETF. They don't get traded regularly. So a big gap up in the morning, you can see it. Where's my drawing tool? The big gap up in the morning right here. And then the nice rally up to the top here. And then it dropped and sold off. And then it was choppy, just like the rest of the market today. So that opening cycle that we can see there, right? The opening cycle of a gap up, a rally, and then a sell-off, all occurring within the first 2-3 hours of the day today. But the reason I want to point this out, it's not because they ended the day up 0.4%. It's because they gained as much as 2.1% at the beginning of the day, which was a sizable gain, and a lot of it came from Tesla, ticker symbol TSLA. With Tesla loads, you can see how they did today, 1.6% up, flat in the after hours. But look at Tesla for the day, though. This is the big thing. For the day, Tesla barely moved. It bounced around a little, but it didn't have that big cycle swing like we saw in the ETF, right? And it's basically flat all day long. But it did hold itself up throughout the day. There were a couple times when it swung to the negative side, but for the most part, it remained positive most of the day. That was good. And it was a reaction to, remember last week on Friday, Elon Musk crashed the market, saying that something doesn't feel right? He doesn't have a good feeling about the market. Well, Elon Musk also last Friday, he said that 10% of the workforce would have to be cut. Elon Musk clarified the workforce statement, okay? And he clarified that the total headcount would actually increase this year. It's the salaried staff that would not increase. So they're not cutting 10% of their workforce, which would have been about 10,000 employees. No, they're not letting 10,000 employees go. They're just not going to hire as many people on the salaried side of the equation. Hourly employees will go up a little bit this year, but the salaried staff will basically remain flat. So, as I said last week, a lot of the market is an overreaction. So, big overreaction last Friday because nobody knew exactly what Elon Musk was thinking or talking about. It was a overreaction because of a news report. Wasn't fact. It didn't come from Elon himself. Today, it comes from Elon himself, and it's not nearly as bad as what the market initially thought from the rumor or report, right? We also had Amazon today. Ticker symbol is AMZN. They finally had their 20-for-1 stock split. It is so interesting to see Amazon now trading at $124.79. That's where they closed out the day, up 2%. They're up a little bit more in the after hours to 125.32. It's just so crazy to see that after this thing. What was its high? Was it 3,000, 3,500? Was that its high? And now, and it's just it's a psychological thing to see this, and it will get a lot of people who thought $2,000 was out of their reach to buy shares of Amazon, but now they can buy shares of Amazon because they think they're on sale, right? It's cheaper. But nothing changed. Fundamentally, nothing changed at the company. So if you are going to dive in on Amazon at their $125 a share, do this. Buy Amazon for AWS, which is their servers. If you buy Amazon for AWS, you're getting, I think, a good deal. And then you'll get the retail part of Amazon as basically a free add-on. So think of Amazon in that way, because retail, it's going to stall for a little bit. But AWS, Amazon's AWS, their servers, that is going to continue to grow. So buy Amazon for AWS and then get retail added on as a free bonus. Think of it that way. It will help make it a little more sense. And then you can spend your time researching the AWS part of Amazon and not worrying too much about the retail side of Amazon. Okay, Apple. Boy, oh boy, Apple had a big day today. Ticker symbol AAPL is the ticker. They had their developer conference today. Alphabet had their developer conference last month, and a lot of cool things were announced. Always cool, always. Every year, Alphabet and Apple, they both have their awesome projects and, new materials and so forth, new updates to their phones, watches, tablets, computers, etc. It's an awesome thing to watch. I love when Steve Jobs used to do the presentation, because he would do it. He would share everything that's new, and then he would have one more thing at the end. I always loved that about Steve Jobs. Okay, so Apple trading at $146. It was up 0.5% today. They're on the 5-minute chart, they were in an uptrend there at the end of the day after selling off again in the morning. But here's Apple right here. On the daily chart, they had their nice snapback rally at the middle to end of March, but then a nice, nearly a perfectly downtrend there on the chart. And they did hit this bottom. Maybe this could be a local bottom. That's what I would call it, a local bottom. And it's picked up some steam. However, its 21-day moving average is kind of acting as a place where it's bouncing around a lot. Maybe it's support, maybe it's resistance, but it's kind of hugging that 21-day moving average right now. The thing about it, though, is as the stock goes down, it's going to bring that average down, which could in turn continue to bring the price action down. So just keep that in mind. Moving averages are one of the most simplest things to learn first when doing your charting and learning to do technical analysis. It is awesome. Okay, let's keep rolling on this. Apple, which climbed ahead of today's worldwide developer conference. Now, those stocks that we just talked about and a few others, they could not maintain their opening momentum. They fell prone to this year's pattern of selling into strength. That has been the biggest thing about 2022. When we go back and look at the S&P 500, SPX is the ticker that I use. The craziest thing about 2022 is all the, quote, selling into strength. Whenever we start to have good days, then selling occurs. And we can see that on many days. Just go pick a day and look at a candle. If it's got a wick, a longer wick under the candle than maybe the candle size, then that was selling into strength, right? Or candles with wicks on the opposite side, selling into strength. That has been the theme of 2022. Now, most stocks finished off their session highs as interest rates rose, and natural gas futures, they soared today. That came out of nowhere, just like it did about a week or so ago. Now, the Vanguard Mega Cap Growth ETF, remember I said it was up over 2% at the beginning of the day? Well, it finished the day up about 0.5%. So it lost a lot. Now, briefly, the 10-year yield, and we can look at that by going to US10Y, the 10-year yield briefly got back above 3% today. That's a big one. And you can see since breaking resistance right here, it has just been on a march higher. Now, it got as high as 3.05% today. 3.05%, up 8 basis points. Now, it finished today, right where it's at right now, 3.04%. Natural gas today, I don't know what was up with that, but it popped nearly 10% today. And then the 2-year, US02Y for the 10-year. And remember, this was trading sideways for a while and just flat, but it's taken off now, and it's in an uptrend again. However, it's reached a point of resistance for the 2-year. And let's see, that is sitting right at 2.75% is where resistance is, and it's at 2.73% right now. And then we've got crude oil, USOIL. That's your, hold on. Okay. That's your WTI crude oil here. And look at this. Since breaking above its resistance and kind of ping-ponging back and forth of that resistance line, it has settled it right here above it. It's in this little pocket. And I would say the risk reward right now for gas is actually on the lower end. So it's sitting right here in this bubble, right? This right here to me is not the time to buy into oil. It got up to $120 a barrel again today. It's at 118. That's where it closed. I would say that your risk reward is greater for a pullback, not an acceleration. But the only little caveat that I would add are headlines about oil-rich nations. What if Saudi Arabia comes out talking again? What if there's some new report about China shutting down or opening up? Those things can affect the price of oil. And unfortunately, a lot of it is an overreaction. Now, with oil tapping $120 a barrel again today, it's showing me that at least right now, there is some resistance at $120 a barrel, because it goes up to that, it taps it, and then it pulls back from it. So it's not able to break above that yet, but maybe every time it goes up, it taps 120, it taps 120, it taps 120. Maybe it's making that resistance a little weaker with every tap it makes up against resistance. Think of it as a sheet of ice, and you've got your pick, and you're tapping into it, right? Every time you tap into it, you're making cracks form, you're making it weaker. That could be a setup, but I still think the risk reward is to the downside on oil right now. Now, today, the reason it got up and extended today is because there was a report out of Saudi Arabia that it's raising oil prices for Asian buyers because of strong demand. But they eventually rolled over, and oil settled the day down at 118, as you can see right here. Now, that move, it contributed to the underperformance of the S&P 500 energy sector. It was down 0.1%. And the energy sector, it swung between positive and negative territories. And we can look at that. Remember, I added those symbols here. I just have to go right down here to them and tap it and slide down, because I believe the last one is energy. Yep, this is energy today. Now, if I go to the 5-minute on energy, you can see that swing up and down, up and down, up and down. Now, going back to the daily view, energy is in a very nice uptrend. Okay, let me fix the chart. There we go. Now you can see it. A very nice uptrend. It's getting close to the top of the trend, the trading channel. But a lot of times what it will do, just going back here to March the 9th, it tapped it, it moved sideways, sold off, rebound. Kind of same thing here. But instead of tapping the resistance line, it's tapping the top of its Bollinger Band, right? And then it'll pull back, move sideways, go up, tap it, move sideways, tap it. And this one it sold off, and then back to tapping it. So the Bollinger Band right now is sitting on the top of the resistance line in the trading channel. So this could get up to that point. It's at 676 right now. I could see it getting close to 700 before tapping that resistance for energy. Okay, so other sectors today that were underperformers included real estate. That was down 0.3%. Real estate, I think, is this one real estate? Yep, this is real estate. Big pullback in real estate until the May 12th bottom, and it's slowly been working its way back up, but it's been moving sideways for several sessions. And then we have healthcare. Healthcare was basically unchanged today. Let's see, is this one healthcare? Yes, it is. Barely moved. Look at that candle. It is flat on the 21-day moving average. The past couple sessions, it's used that 21-day moving average as support. Okay, that's good. It is still under its 50-day, so below your 50, it is bearish. 50 above is bullish. Okay, information technology, that was up a little bit, 0.04%. Yeah, this one. There we go. Here's technology. All right, technology has resistance right now. I mean, it's just using its Bollinger Band as a resistance point, which is just slightly under its 50-day moving average, keeping it down. But it's moving sideways. That's an interesting development there over the past few sessions. Then we have consumer staples. That one was up to 0.05, I believe it was. Consumer, is it this top one? That's discretionary. consumer staples. And this has been very volatile. When you look at the Bollinger Band, the top of the band is way up here at $815, and the bottom of it is down here at $728. One thing to know about the Bollinger Bands, they're great to use. They show volatility. The further they are apart, the more volatility there is in the stock, the ETF, whatever it is you're tracking. The closer they are together, the tighter that price action is, less volatility. So in general today, there wasn't much conviction on either the buy side or the sell side. And that showed up in the relatively mixed advanced decline line for the NASDAQ and the New York Stock Exchange and the sector leaderboard that featured only one sector with a gain of at least 1%, and that was consumer discretionary. It was up 1.03%, so barely breaking it, but still it did. And again, it is way down here in the bush. Let's take volume off for right now. I should have took that off earlier. My apologies. So it's down here. Again, it's getting close to the top of that Bollinger Band, moving sideways over the past few sessions. It's like traders, investors are not sure where they want to take the market right now. Do we want to go higher? Do we want to go lower? And right now, the risk reward is for lower right now. Okay, so consumer discretionary, it did enjoy a hefty support from Tesla and Amazon to get to that 1%. Now, communication services, that was up 0.98%, in materials, up 0.97%. Both of those finished just shy of the 1% gain as well. Now, there was no economic data of note out today in the U.S. Looking ahead to tomorrow, we get the April trade balance report at 8:30 a.m. and the April consumer credit report at 3 o'clock p.m. That one I am very interested in, because in my market thesis, I think the consumer is being weakened right now. And the consumer is having to dip into savings in order to pay for daily necessities: food, water, shelter, fuel, right? So I think this is going to show that consumer credit has increased, because some who have gone through their savings are now starting to use credit to get their necessities, which is a bad deal, a bad place to be in. All right, I just want to touch on two things right quick, and then we'll get to your questions. First is Apple and their WWDC22, and a note that Rivian sent out to shareholders. I think it reveals a few things. So first, Apple, AAPL is that ticker symbol. Now, like I said earlier, they had their Worldwide Developer Conference, and they had a ton of announcements. Apple will provide developers with even more powerful technologies to push the app experience forward. Apple also unveiled an all-new lock screen experience and a new way to share with communication within iOS 16. Now, the iPad OS 16 takes the versatility of the iPad even further with new and powerful productivity and collaboration features. Apple unveiled a new MacBook Air, supercharged by the new M2 chip. Apple's Watch iOS 9 brings new features and enhances the experience. Now, this is a big one, and it will affect other stocks. Apple announced at WWDC 22 Apple Pay Later. What does that sound like? Apple Pay Later. That sounds like buy now, pay later. Who would that affect? Apple Pay Later will let its users split their bill into 4 payments over 6 weeks with no interest. We've got Affirm being the number one stock affected by this. Shopify, Square, PayPal, they will all be affected by Apple Pay Later. While Apple did have a lot of good technology that they talked about during their developer conference, that one, Apple Pay Later, I think is a big one. As a matter of fact, let me check in on Affirm. AFRM is the ticker symbol for Affirm. Now, Affirm is clearly a buy now, pay later type of stock. How did they do today? Down 5.5%, down 0.5% in the after hours. Now, I don't know the exact time of day when Apple reported the Apple Pay Later, but if we look at the 5-minute chart here for Affirm, they ticked up in the morning, and then in the afternoon around 1:30ish, 2 o'clock, that's when they started selling off. So I wonder if that's when the announcement was made about Apple Pay Later. Interesting. All right, let's hop over to Rivian. RIVN for Rivian. That's their ticker. Now, Rivian highlighted backlogs and investments in a letter to shareholders today. Rivian believes that their partnership with Amazon is strong, and the initial order of 100,000 vehicles will enable it to work with one of the most sophisticated fleets, which is the Amazon fleet. And Rivian believes they will gain a ton of experience working with Amazon in that way. Rivian also believes that the most change over the upcoming 10 years is within battery supply, and specifically the battery supply chain. Where do the raw materials come from to create these batteries for these electric vehicles? So Rivian thinks battery technology, battery supply chain, that's where it's at in the next 10 years. So with doing a little extra thinking on that one, finding the companies that provide the raw materials for the batteries, or find the companies who are making the batteries, would be a good bet for a long-term buy and hold situation. Now, Rivian did talk about battery capacity, and it's expanding, and Rivian is expanding that. Let's see here. What else? Rivian also talked about the battery development expanding by 20-fold. From now, 10 years from now, battery technology, the way that the battery is put together, the supply chain, everything is going to improve 20x from now and a decade out for batteries. So that would be a good ride getting on people who make batteries. See, this is why I like Tesla so much. I know we're talking about Rivian, but Tesla is basically trying to become the beginning and end for the electric vehicle. They want the raw materials brought to Tesla. It goes through a factory, and out the other side pops an electric vehicle. Battery, everything made in that factory. Seriously. You dump off the raw materials, it goes through the factory, and out pops an EV. That's why I like Tesla so much. So I get why Rivian is saying battery is so important. Rivian is also seeing a growing demand and its backlog. They have, I think they said 90 or 91,000 plus R1 pre-orders, and its production plant in Normal, Illinois has 150,000 unit annual capacity to produce their R1T and their R1S. And it does have plans to ramp up its supply chain and production to fully utilize this capacity. Now, as of March 31st, 2022, so just a couple months ago, Rivian says that they had $17 billion of cash on its balance sheet, which will support the 2025 launch and ramp up of the R2 vehicle platform. Now, the R2 vehicle platform is their next generation. The R1 is the current generation they are building now. 2025, right, they should have a next generation, the R2, up and running. And Rivian believes that they have enough cash on hand to support the ramp up in production of the R2 platform. Okay. So that was the main points that Rivian talked about there today. Okay, let's see here. Do you feel in general that some stock prices reflect low guidance that some companies have reported in future earnings? Absolutely. Absolutely. To give you an example of that, Advanced Auto Parts, for example. Let me get it off the 5-minute here and put it on the daily. Advanced Auto Parts, okay? Very simple to understand. They sell auto parts. So if you have a vehicle, it breaks down, you want to buy a part, there you go. You go into Advanced Auto, you buy the part. If you don't know how to put the part on, you can have Advanced Auto take the bad part off, put the good part on. Obviously, you can go to your dealership to have that done too, but sometimes people don't want to. Or warranty is out on the vehicle, so they pull into Advanced Auto. Now, there are other auto stocks out there. For example, O'Reilly's Automotive, competitor, another stock on the stock market. You also have AutoZone, which is another parts retailer, just like Advanced Auto. Now, the three of those companies don't all report at the exact same time. But usually what happens is when one reports, the other two, the stocks will move based off of what that first report said. So if Advanced Auto has their earnings first, and then a week later, O'Reilly has their earnings report, O'Reilly stock will be affected by what happens to Advanced Auto Parts. The second thing that happens is if Advanced Auto Parts, again, has their earnings, and then a week later, O'Reilly has their earnings. If Advanced Auto says, yeah, you know, Q2 looks like it's going to be a bad quarter for us. That's their guidance for next quarter. They say it's going to be bad. O'Reilly stock will act negatively to those comments. Now, a week later, when O'Reilly reports, they may do or have better earnings report than Advanced Auto. They may also say Q2 is looking great for us. We just opened a new auto parts store and it is doing excellent, and it's going to help our comps be better. So then the stock for O'Reilly shoots up because, O'Reilly got oversold. because investors were reacting to what Advanced Auto Parts said during their earnings report. So it happens all the time. It's typically within the same subsector or the same sector. For example, what Advanced Auto Parts says does not affect what Microsoft's earnings will be, and vice versa. If Microsoft says they are going to have a great next quarter, they're going to have a great fiscal year, that in no way will affect Advanced Auto Parts. So it has to be in the same sector or the same subsector to have an effect. And the more closely they are related, meaning if they have a product they sell, if those products are very similar, if they offer a service and that service is very similar, then they react in tandem to one another. The same thing happens with fast food restaurants all the time in the market. You might have McDonald's report, and then Wendy's follows right along with whatever happens to McDonald's stock, and based off of guidance for McDonald's, Wendy's will either go up or down based on McDonald's guidance. But then when Wendy's guidance come out, typically they're pretty close anyways, so maybe that's not a fair example, but they do all move in tandem to one another. So I hope that helps to answer your question there. And let me just read it one more time to make sure I did. Do you feel in general that some stock prices reflect lower guidance that some companies have reported in future earnings? So, yeah, I think I answered that pretty good. The answer is yes. And it's not just a do I feel whether this is happening? This does happen 100%. And again, the closer the two companies or 3 or 4 or 10 or 15 are related to what they do or sell, then the more they will move in tandem with one another. That's why another cybersecurity stocks, right? They can move a lot of times in tandem to one another. Semiconductors, again, sector or subsector, the closer they'll move together. You are welcome, Dave. I'm awesome. I'm glad that helped. Yeah, that's going to have everyone buying the best model iPhone. Yeah, I think so too. I think that's Apple's job right now, isn't it? Apple's job right now is to make a product that is a little bit better than the prior year's product and get as many people to buy that product as possible. I mean, as I just said that out loud, that's really the what every company does, right? Every company has a product or service, and they always want the customers buying the newest and latest and best model. So I also think that these developer conference that Alphabet has and Apple has, I think they're designed for two different things. One, they're designed for the developers within the developing community to learn about what's new, what they have access to, what is being built to help the developer. So it's really information for the developer. And then the second thing that these conferences do is they get the hardcore fans. I don't know what's the right word to use, but they get the hardcore fans psyched, pumped up, totally excited about these new products, which in turn once you get the hardcore fans all pumped up and excited, then that will trickle over to the casual consumer about the products that are coming up from Apple or Alphabet or from even this isn't just exclusive to Apple and Alphabet, even though those are the two big ones that a lot of people want to see and want to hear about each year. But Bed Bath & Beyond does something similar. It's just not on the big scale. They have investor days or they have analyst days. Almost every company on the market. Well, I take that back. Not every company. But the majority of companies in the market have either an analyst day or an investor day. And it's similar to what Apple and Alphabet are doing, just not on such a grand scale. And of course, typically they don't have those exciting products either out there. Okay, well, that was everything I wanted to cover. Is there anything that you guys want to go over? We most certainly can. Let me check in on crypto. I haven't done that, and I that's something that I want to do too. First, let's pop up the SPY, and I'll pop up the Qs afterwards. All right. So here we are with the SPY. You can see, look at that, right up against that resistance at 415 right now. And let me point this out too, okay? And I'm going to give a visual for this. Have I traded SPY? Yes. Yes, I have. I've done a couple of I wouldn't call them big trades, smaller trades on the SPY, just to kind of get a hang of it. All right, so I'm going to put these two boxes on here. The first box is going to go right here, okay? And actually, let's go like that. Okay, and now I'm going to put a second box on here. What did I just do? There we go. Now I'm going to put a second box if I can get this thing to move. There we go. I'm going to put a second box right here. I'm going to attach them, and I'm going to bring this one down and then change the color. Okay, so the first box here on top is green. What this is your risk reward right now in the SPY. So with the SPY getting congested here, squeezing up together, right? It's compacting. One of two things are going to happen. We're either going to get a break up to the upside or we're going to get a breakdown to the downside. Now, if we do get the SPY to move up, resistance comes in typically at the top Bollinger Band. And then right above that, at least for right now, we've got the 50-day moving average, which is coming in at 423. Now, below the green box, we've got our red box. If it breaks down, the bottom of the Bollinger Band comes all the way down to $384. So right now, your risk reward, this is what it looks like. If you're going long, you don't have a lot of reward, but you have a lot of risk. if you're going short, you have a lot of reward and you have a little bit of risk. Seeing it like this, does this help to make more sense, to help to visualize the risk reward of where we are in the market right now? For me, it does. I'm a very visual learner. I like to see how things are playing out, what things look like. And we can apply this then to anything else. Let's go look at the Qs. Okay, get my cursor on the right screen. Let's go look at the QQQ. And again, it's almost identical, quite frankly. If we put our box in, all right, and this one is green. And then we put our second box in. And turn this one red. So this is our current risk reward for the Qs. The green box is slightly bigger than the green box was for the SPY. That's interesting. Okay, so that's kind of visualizing your risk reward from where we are at this precise moment in time. So if we get good news, then what are we looking at a move here? The move up would be about 2.7%. And then the move down would be right about 7.5%. Okay. Price boxes do help. Okay. Maybe we can start incorporating those on here as well when we're talking about different stocks. Now, to give an example, if we go back to the snapback rally we had at the end of March, once we reach the top here, let's just say we had, a box like this, and that would have been the green one. And then our other box obviously would have dropped down here. That would have been our red. Now, we didn't hit. So from this point, and I'm going off of March the 25th, which was right a few sessions. So we got the 25th, then we had a weekend. So then the 28th was green, 29th was green, and that was our top. March the 29th, 2022. That was our top. So we actually were able to do better than what the reward was at that moment in time because of the gap up, and it actually gapped up and closed right on that 200-day moving average. So those 200-day moving averages do come in play. So if I were to look at today and say, okay, we have got ourselves another area here. I'm not going to do a dark green. I'm going to do a lighter green because the 50-day moving average is up there. And like we just saw here, the end of March, the 200-day moving average, and sometimes this is true, and I don't know if I've ever said this before, moving averages can act like magnets, pulling price action to them. And that's why sometimes they get to a moving average and they just really stick right there on it. So the 200-day moving average pulled the price action up to it on March the 29th, and then we fell underneath it, and we back tested, got rejected. Instead of closing above it, we closed under it, which is a rejection of the 200-day, and that's when we sold off. So it is possible that we have our reward box right here for where we're at. But if we get some kind of positive news in the market, maybe the Fed's not going to be as hawkish, maybe that could lift this up a little bit higher. And, maybe we gradually go up like this, and then we meet that 50-day moving average, and then that 50-day moving average, I guess I need to draw the line first, then turns into our resistance, sending us down. All right, that's interesting. I'll leave that there and see if the QQQ follows that in any way. Because we do have our Fed meeting. It is on the 14th and 15th. So we still have one more next week. Oh my gosh. So next Tuesday and next Wednesday. So next Wednesday, the market's going to move hard. And quite frankly, if we're talking about the market, next Tuesday and Wednesday will be one of the biggest things in that's going to drive the market. So I could see potentially the market continuing to consolidate and move sideways. I'll take volume off. Just like it's done. I mean, look at this. 1, 2, 3, 4, 5, 6 sessions in a row now. Just kind of moving sideways. I could see this type of movement maybe gradually going up or gradually going down, not by a whole lot, until next Tuesday and Wednesday. And then if the Fed is hawkish about September, the market's going to go down. If the Fed is dovish about September, the market will go up. If consumer credit came in high, that would be bearish for the market. If consumer credit came in high, yes, that would be bearish for the market. Now, I think for the consumer credit, I think the consumer is being weakened right now. I've said it 100 times. Gas prices are at record highs, which makes everything else cost more too. I think it's going to come in. Consumers are using more credit because they've dipped into their savings. Unfortunately, maybe there's some out there that have run through their savings, and now they're starting to dip into credit to pay for necessities: food, water, shelter, fuel. So if more consumers are using credit, that is a bearish take for the market. Now, it is possible that market participants see a bearish report and they don't act. because with the Fed a week away, 1 week away, that's what they're focused on. So that's why I think the market could consolidate for the next week. Maybe it slowly drifts down or drifts up, but I don't think that we're going to have really big moves. But let's just look. I could be wrong. If we go back to what was leading up to the last FOMC meeting, the market didn't move sideways. May the 4th is when the market heard from Jerome Powell. So right here, this candle right here is May the 4th. So that afternoon, Jerome Powell came out, the press release came out a half hour before he spoke, and boom. And then that sent the market down. Now, you could say we have these 2 sessions right before the meeting. The market didn't move that much, but it was up 0.5% both days. And then we get 1, 2, 3. So this is a week out from the meeting. So the market actually dropped 2.8% leading up to the FOMC meeting for May and the announcement. Then once the announcement was made and we got the 250 basis point rate hikes, that's when the market went on its run to the next big low of the year, a 10.6% drop. We have our rally, a relief rally. Now we're moving sideways. We could get some volatility, but continue to move sideways until the meeting. So that would be again, this is a hypothesis. This is just a gameplay of what could happen, a probability. It doesn't mean that's what's going to happen. Because nobody has a crystal ball unless you've traveled from the future. But I don't know anybody who's traveled from the future. I think we're setting up for the Fed to give us our 4th low of the year. That's what I think we're being set up for, which would be this next yellow box down here, 3,500 on the S&P. If the Fed comes out next Wednesday on the 15th and says we have to be more aggressive to get inflation down, that will send the markets down. If the Fed says we have to do a 50 basis point rate hike in September, that'll bring the market down because the market right now is priced in a 25 basis point rate hike in September. The Fed could even say, we're not doing a 50 basis point rate hike this month. We're going to do a 75. That would send the market down. So anything above what we're expecting, which is a 50 basis point rate hike this month, so the 15th, a 50 basis point rate hike in July on the 27th, and then a 25 basis point rate hike in September on the 21st. Anything above those numbers means the market's going down. And I do not believe there is a big probability. I don't even think there's a little probability of the Fed lowering their rates. I guess they could be looking at a bigger grand scheme of thing. They could see a recession is coming. They see inflation is high. They see the job market is maybe letting off some steam. I don't know that it's forming any cracks in its foundation yet, but it is letting off some steam. And maybe they say, to avoid the recession part of this, we're going to let inflation run hot for a little longer to try to build up the economy's strength. Maybe. I don't see that probability. I can't even envision that probability. So that's what we're looking at. All right. Well, if there is nothing else, we can relax for the evening and go into tomorrow. All right. Seems like it's overall just bearish. It is. It is. You're welcome. One more point, because of that comment right there. It seems it's overall just bearish. All right. I just got rid of all my drawing tools, so it's tougher to see. Since we reached our peak, okay, which is right about middle of the screen, all right? Since we reached that peak, we are making lower lows and lower highs, right? So on the chart, from our peak right here, and I wish I could draw, but actually there is a way I think I can do this. Yep, there is a second. No. All right. Hold on one. I'm just trying to clear out just a couple of lines here so we can see this. So the market right now, it is in a downtrend, and it's a confirmed downtrend. We are making lower lows and we are making lower highs. Until that trend is confirmed to have reversed, you must have a bearish bias on the market. But remember, just because you have a bearish bias on the market does not mean the market cannot rally at times. So here we go. We peaked right here, okay? We are making a lower low, a lower low. Each time we go down, we make a lower low and a lower low. So the last one was on May the 20th. From the high, again, up here, we are making lower highs as well. Even though it's just one, I mean, you could maybe count that one as the second one. Depending on what happens here, maybe this could be a third one. But until this trend is broken, until we start making higher lows, and until we start making higher highs, there is a bearish bias on the market right now. Now, what we have going on right now, this could potentially be the beginning of a reversal. There is that. What am I doing? I'm just drawing all kinds of lines on here now. There we go. Our rally that we had from the May 20th low, that could be a potential setup for a reversal. I don't think it is, but there is that probability that it could be. I believe it's a very low probability, and I believe we will see another low, at least one more low, before we start digging out of this. Because I don't think, if you look at this rally that we had, that we just stalled from, this rally right here, to me, that rally is very steep, right? It's going up way too fast. Once we see a reversal, I think the path of digging ourselves out of it is gonna, be a little more slower, right? A slow dig out of this hole. I don't think it's going to be a rapid bounce straight back up. Okay. All right. So that's everything. Just want to add those two things right there to help clarify your thoughts there. Okay. All right. Well, you guys have a wonderful evening. I'll see you tomorrow after the market close. Make sure to click that like button, share this video. If you like this content and you want more of it throughout the day, then click the first link in the description and join us over on Patreon. That helps the channel, plus it helps you grow as you're along your investor journey. And if you have not set up an account on Webull yet, click the link. It's the second link in the description of this video. Do so. That's 6 free stocks. You can always get those stocks and the money that comes with it, and then you can transfer that money out into whatever investing app you're using. So, that is a possibility that you can do. Obviously, it's not the marketing goal of Webull for you to do that. However, it is a possibility for you. So if you haven't yet, click that second link, get your 6 free stocks. Again, it's valued at up to $12,600. If you do it, let me know what stocks you get in the comments of the video. I'd be curious to see what type of stocks they are distributing. That would be interesting in this particular time in the market. All right, ladies and gentlemen, thank you so very much for joining me today. I greatly appreciate your attention. I greatly appreciate you for being here. So thank you, and I'll see you in the next video.